So to continue on here, this order block that I've marked up here as being bullish on EU, this order block needs to be broken. Price needs to close below that order block. Price needs to test the order block if this becomes our breaker over here on a daily time frame, and we can expect price to go lower once we have that order block in place, because price then is showing us willingness to go down, that the fact that that daily strong bullish order block is broken. If price respects that order block like I expect it to do, I do see that price will bounce around in this zone because of the fact that it is a strong bullish order block and it is the daily time frame. So daily takes precedence over the 4 hour. So this large candle we have here on Friday, it is essentially just trading into this daily bullish order block sitting over here. So hopefully that answers your question that you had on that particular EU question. Okay, so if anyone else wants to ask any questions, you can post them in the chat or you can ask me here. That's no problem.
Hi, Darren.
Yes, go ahead.
There's someone who posted a question in the Telegram. I forwarded it for you in the chat.
Okay, so question from a guy who can't join the meeting. What sort of reaction should we be looking at when price is being rejected or breaking the OB or closing an FBG? Okay, so we can just use, most people trade EU and GU, so we shall use those as examples. So he's asking, what reaction are we looking for when price is being rejected or breaking the OB and closing a fair value gap? Well, essentially, how you do it is you mark up your chart from scratch. So here we have this 4-hour order block on EU sitting over here. Okay, so this is a strong block of orders that the institutions have orders that took price lower over here. So we see that that is a strong order block based on the fact that when price got to this area, it dropped. Okay, so that is a strong order block because there is a large move to the downside. So again, if we look here, when that order block was created over here, there was aggressive move to the downside. And along the way, while that aggressive move was created, there was imbalance of price. So when the imbalance of price happens abruptly, like it did here, quickly, effectively, there is evidence here in these candles, 1, 2, 3, 4. So this large move for 8 hours here to the downside paints us a picture. There is evidence in these candles that there is movement to the downside. They are executing sell positions. They are selling transactions to other banks, to other institutions. They are transacting in a way that is not bullish. So that is the order block that has been created over here. So how do we know that price is going to reject here? Well, we have to wait and see. But what essentially we train our eyes to see is that when we see a strong bullish or bearish order block created, we want to sell at the bottom of the order block over here, the opening candle, or the 50% of the order block. Those are where essentially we want to sell when we see strong bearish or bullish order blocks at the opening candle or the 50%. Now, as you see over here, if we had entered at the 50%, over here is 32 pips. So this is a raid on liquidity, because keep in mind, this move over here was the entire move from July. So this candle over here if you look, was the 31st of July. Okay, so this candle over here is essentially the monthly high. Okay, because it is the monthly candle. So that was the monthly high. Okay, so why did price come above here? Well, not only because it was the previous day's high, it was liquidity sitting above there, and also there was a large move to the downside. So they accumulated sellers while price was traveling down over here. So while price was traveling down, they were collecting sellers into the market. And as retail traders like to do, put a buy stop above here. So this wick comes in there, activates the buy stops, and then runs out the liquidity. So when you see a what we call a run on liquidity, a rejection of price, or a turtle soup, as some people call it, that is a sign to us that the liquidity sitting above here has run dry. So there's no reason for price to go back up there, because as you see, this order block has been respected. So there's no more telltale signs to you based on just by looking at this 4-hour chart. The fact that this is the price action that you essentially want to train your eye to see is you have this 4-hour order block on your eyes, and it is respecting the IPLs. There has been a run on liquidity on this wick over here. So this wick ran liquidity and price rejected back down, and you can see 50% that order block being respected. So as I said, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 10, 11 candles, giving you 40 hours to get into a sell trade over here because of this large candle that created this move to the downside. So it even broke this strong bullish order block over here. So that was a strong bullish order block. This order block was strong because it was able to take price high for 1, 2, 3, 4, 5. For 5 hours, sorry, 20 hours, price was able to go higher from this order block. So there's a lot of orders that were sitting here to take price higher, and then that order block was broken. So that immediately tells me that they are showing signs of weakness based on the fact that they were able to break that order block over there. So we have just on this 4-hour chart 2 confirmations right now. So if we look at it, here is our 4-hour order block over here, essentially. And here is our round number IPL. And here is our 800 IPL, about somewhere there. 800 IPL, round number IPL, both of them being respected when price comes back into this 4-hour order block. Now, if you're following the order flow strategy, well, then we know that that is also our source candle because price created the breaker. So now you have a source candle, you have a 4-hour order block. Now let's look at a lower time frame. So if we look at the lower time frame and we zoom out over here, that's obviously we know that price is coming into this area because it is closing out all of this imbalance that was created along this move to the downside, as we see over here. So there is imbalance of price. So there's an imbalance sitting over here, and you can see that this imbalance was traded inside for a while over here. There's imbalance sitting over there. So that imbalance was closed over there. That is a 1-hour fair value gap. So if you go down to a 30-minute chart, and let's see what is happening on the 30-minute chart. Do we get any other fair value gaps? No, we don't. But we still know that there's fair value on a higher time frame of 1 hour. So that fair value gap will be closed. So even if you take a trade and you have your order block, you have your IPLs sitting over here, there is 3 confirmations to take the trade. Even when price gets up to this level and you haven't placed a sell limit, you can still be patient and wait for further action, because while price comes into this 4-hour order block, you can watch the 1-hour time frames price action and see these moves being created over here. So this 1-hour order block was created over here, and price aggressively moved for 1, 2, 3, 4 hours to the downside. Okay, so there we go. So we could even set then a sell limit at the 50% of that 1-hour order block once we see that price action. Now, if you measure from that week to that week, that's only 26 pips. So now you're still in the trade if you're using about a 30 pip stop loss. I like to say 30 pips plus broker spread. So 31, 32 pips, whatever your broker spread is. But essentially, that will still keep you in the trade. And even then, if you're still not convinced that you had entered over here, you could wait again for price to drop, still showing that this 4-hour order block is being respected. So you can essentially look for a sell here. So if we look at that time in the 15 minutes, let's go down to the 15-minute chart over here. And here is that run on liquidity sitting over here. So what essentially can we do? Well, we know that price is respecting this 4-hour order block marked in this red box. We have our round number IPL. We have also our 800 IPL. We have that 1-hour fair value gap closed multiple times on the higher time frames. 1 hour, price dropped. 1-hour time frame, price dropped again. So this is a 15-minute chart now. So here we have a high that was also the high that was the run on liquidity, and there we have a low. So now what do? We pull the fibs from those highs to those lows. And what do we get? We get 79% over here. Here's our sweet spot in this zone over here. So we could have taken a trade from the 4-hour. We had marked up the order block and the source. We dropped down to a 1-hour. We identified a fair value gap. The 1-hour gave us, as we saw here, multiple times weakness. So it respected the order block. Price dropped on the 1-hour. Price came up again, failed to go even higher than this 1-hour order block. It wicked up, taken out the liquidity of the previous days, and dropped again. So now this is giving us the third time or the third opportunity to get in on the trade. And the market just isn't going to keep giving you opportunities. You're going to have to take them, and you're going to have to risk money at some point, because every time you enter a trade, you're essentially risking money. And if there's no money risked, there's no money gained. So sure, you can watch price action for your entire life, but if you never make a trade, you're never going to learn anything. So whether you do it on a live account, a demo account, or cent account, or standard account, ECN account, doesn't matter the account. If you're not taking trades that you see or want to sell or want to buy, you're never going to learn. So you have to take trades. You have to use your time frames. You have to use these confirmations to take your trades. There's multiple confirmations here that was a sell opportunity. So hopefully that answers your question. So John, it depends which pairs you are going to choose. So you asked me what times should we be looking for trade setups and what times should be out of the market and not take any trades, even if a setup presents itself. Well, essentially, it depends on what kind of trader you are. So if you trade, Euro USD or GBP USD, essentially you want to trade around the kill zone times. So if you look at the kill zone times over here on this specific chart, if I zoom in here, the orange line to us represents the London kill zone and the blue line represents the New York kill zone. So it's really up to you to determine for yourself, are you a scalper? Are you a day trader? Are you a swing trader? Are you a position trader? And once you can define that, then you can answer that question. But essentially, if you're a scalper, if you're a day trader, then your entries are important. So you will want to enter anywhere outside of the Asian range over here. So all the way into the Asian range you can trade. which type of trader is not restricted to kill zone entries. So if you are swing trading and position trading, it is more important to have a higher accuracy on your directional bias, because essentially you're going to be holding the trade over a longer period of time. So when you swing trade or position trade, then your entry is not as important as which direction are you going to buy or sell. So those are the types of trading that are not important for the kill zones. When you are day trading or intraday trading, you essentially want to look for good entries so that you can have a tighter stop loss. Whereas a swing trade, generally your stop loss is larger. On a position trade, generally your stop loss is larger. So that is the types of traders that you need to be in order to take those kind of entries around either the kill zones for scalpers and for day traders, swing traders. Entry is not as important as directional bias. Another question here: what do we look out for as price approaches the premium or discount array before taking a trade? Because price disrespects PD arrays all the time, especially in lower time frame. Like I said, baby trader. So when you are seeing um, a discount or a premium in price, you essentially want to convince yourself to be able to take that trade. So at any time you are looking for a discount of price, um, let's just look at a 1 hour time frame here and look for some bullish setups. So when you want to buy, you need to have confidence. And this again comes down to what kind of trader you are, because some people like to track trades just by using fibs, and there's no harm in that. Okay, you can take trades based on just fibs, but if you have additional confluence, so let's just take an example over here. This was a bullish order block over here, and we can see, so that was a bullish order block. So I've marked up a higher time frame order block, and I want to go down to the 1 hour price levels to see if I can find myself an entry or a reason for price to come back to a certain level. So now I'm on a 1 hour chart. Well, here we go. There we have another gap in price over here, an imbalance, a fair value gap on a 1 hour time frame inside of the 4 hour fair value gap over here. Sorry, inside of the 4 hour order block, we have a 1 hour fair value gap. So there, two confirmations. Now we go down to a 15-minute chart. 15-minute chart. Okay, here we have a low of the bodies to the high of the bodies before price started to retrace. So pull our fibs from body to body, and essentially when price bounces off of a sweet spot, 62, 70.5, 70.9%, you want to take your trade because you have other confirmations. And again, this applies to what time frame are you going to be trading off of, because I just did it from a 4 hour to a 1 hour to a 15-minute, but essentially you can do it from a 1 hour to a 15-minute to a 5-minute. It all depends on what type of trading style that you are looking for. So this is a 4 hour, a 1 hour, 15-minute. Now let's look at a different scenario where we can use lower time frames. So we will start on the 1 hour. So again, let's just look for a order block on the 1 hour. So here is an order block, a 1 hour order block. Okay, so we know that for at some point, at least for a couple of hours, price will want to blast off out of this bullish 1 hour order block. So we can catch maybe 10, 20, 30 pips. We're not potentially going to catch a swing trade off here because it's only a 1 hour order block. So we're going to have shorter trade times because it's a lower time frame. So now we're going to use the 1 hour. We've marked up the order block. Now we can look at the 15-minute prices at that zone over here. So there's a 1 hour order block and 15-minute time frame over here. Essentially, what do we see? 15-minute time frame shows us from this 1 hour order block, we have a large area where price is imbalanced and price moves away from this area. So what essentially are we looking for? Well, we have a order block, 1 hour order block. We have a 15-minute liquidity void sitting over here. So this is a large bullish move to the upside, painting evidence onto the chart that there's transactions and we can look for a buy. So swing low or bottom of those bodies to swing high, top of those bodies, and pulling fibs. Now you get this over here. So we have this gap filled over here and price then bounces. Okay, so as an example, this would have been a good entry. But let's say, for example, we missed that entry over here. So what do we do? Let's zoom in and see if we can get another entry for ourselves using the fibs. So we already have an order block marked up, the pink 1 hour order block, the 15-minute fair value gap in purple. Price has already bounced off there. We've missed our opportunity. Now we want to get in again. So swing low of those bodies to swing high of these bodies over here. And then we pull our fibs again to those highs and again those highs and again. We get the price we want at discount because we are looking for buy opportunities. So there, 1 hour, 15-minute, and you can even go so far as to do it on the 5-minute, the exact same scenario I just showed you here. So 15-minute fair value gap closed. Now let's go down to the 5-minute time frame, and essentially everything I just showed you can be repeated. So these can just go and that can go, and here we still have the bodies of those highs to the bodies of these lows. We pull our fibs because we are bullish, and there is our sweet spot. So if you don't take a trade there, well, you're never going to take a trade. So you have to take a trade if you have an alignment of confirmations. So just by this, we have 3 confirmations to take a trade over here. So it's you need to do the work to get used to seeing these kinds of setups, but you can do it any time frame you want. Obviously, the higher to the lower time frames are better because you'll get more pips if you're a day trader. If you're a scalper, then obviously the lower time frames, you'll get a quick movement on price and you'll make a lot of trades during the day, for example. So the setups will come more frequently on lower time frames, whereas the higher time frames, they won't come as frequently. How many pips to know if it's a fair value gap or a void? Josh, well, that's not a relevant question really, because the chart candlesticks paint us fair value. It's not about the pips. Pips can be any amount. It doesn't matter. The fair value gaps and the liquidity voids, if it's a large move without wicks being intersected in that price level, then it's a liquidity void. If it is a fair value gap, then there's a smaller version of a liquidity void. And there's no rule to say that it has to be 10 pips or 20 pips or 50 pips to be a fair value gap or a liquidity void. If you see imbalance of price, then it's a fair value gap. So you need to go watch that video explaining the concept of fair value. And you'll see I don't speak about pips because pips are irrelevant. You don't count pips on a fair value gap if you want to identify it as a fair value gap or not. Yeah, it depends on the time frame that you're looking at. So pip counting for a fair value gap to determine if it's a fair value gap is irrelevant. You don't need to use pip counting. Anyone else got any questions?
Yes, Darren, I got a question.
Yeah, sure, go ahead.
Okay. Can we go back to EU on H1 USD?
Yeah, sure.
Okay. Is it possible that a price might be coming over to the FVG above? Just there's
Yes,
something that looks like an average.
this
Okay.
one here.
Okay. Yeah, Monday, like price might be coming there. So maybe we should look at price action there to see if that could be uh, an opportunity for a shot.
Correct. So you can expect price to close over here because they would want to come back here. If they want to take price low because we know the order flow has changed, so we're looking for potential sell setup. So this could represent a good sell setup. So if you look on the 4-hour chart, that's also a gap on the 4-hour chart. It's actually
Yeah.
quite a large gap over there. So yes, it is very likely that if they do want to take price lower, they will take it higher first to bring it lower. So they won't just sell it off. They'll want to take it higher and then sell it off.
Okay, thank you. Sorry, I got just one more question, but I know it's kind of like it's funny. But when we get to USDs, when I use my crochet to calculate pips, like do you calculate it normally like other pairs because I see a lot of numbers and USDs are and I don't know, is that the number of pips that is being
So
sort of looks like
this is
volatility index or
not
something?
pips. It
I
is not
mean,
pips that is showing you here. It is points. So essentially, all you need to do to identify the pips, if you're using MetaTrader, is you just cross off 1 7, or sorry, one digit. So that is, if you see on my chart here, 348 pips, or
yeah.
3,487 points. So that is pips, 348 pips.
Yeah, I know you have to remove the last number, which is the
So
pipette.
that's all you have to
So
do.
really, okay. Like on USDs, like removing the last number, the rest of the number you see there is the number of pips.
Yes. So there's 4 digits when you pull your crosshairs, and you just forget the last digit, and that is your pip count.
Okay, thank you. That's too much. That's yeah, right, too much.
Okay. Anyone else got any questions before I go over some of the trades I took this week? Okay, well, no one has any more questions. Perfect. So, uh, here I have a trade that I took, and the accounts that are connected to copy trading would have taken as well. So here we have ourselves an order block sitting over here. So this is a 4-hour bearish order block, okay? And also on the daily time frame, this, if we look here, is a strong, let me just move that out of the way. So this is a strong daily order block sitting over here. That was a daily order block. So that we can mark up as blue over here. Blue, not pink. Okay, so this is a daily order block. So we know on a daily order block, this one here. So we know that there's a large selling volume because there is a large group of cells that took price lower and broke this market structure over here. So that is a reason to take price lower again when price comes back into this daily order block. So then we know that price has this daily order block. We go down to the 4-hour chart, and this is a 4-hour order block over here. So that is a large 4-hour order block. Okay. So on the 4-hour order block, the daily order block, we also now have a fair value gap sitting over here on the 4-hour chart. And obviously, being a fair value gap on a 4-hour chart, it is taking higher precedence over lower time frames. So there we have 4-hour order block, daily order block, fair value gap, 4-hour, 3 confirmations. Now we take a fibs from body to body over here, and we see that there was a sweet spot over here of price to come back into, as well as balancing this imbalance of price. So this was one of the trades I had executed because of this large move to the downside over here. That is evidence to me that the institutions are selling. So they will want to bring price back up to sell it again. And that is a trade I was personally in, as well as the others. And we had basically entered the middle of that fair value gap with a 30 pip stop over here, which probably wasn't necessary, but 30 pips nonetheless. And we closed just before NFP, which was, I don't know, about 30 or 40 pips or whatever our brokers determined, but that was essentially a decent trade. And also there was another trade on USD CAD, which was a very similar setup over here on the 4-hour. So here we have a daily order block. We zoom in here, same scenario. Price is respecting this daily order block over here, and that is a daily order block. So now we go down to the 4-hour. Inside of that daily order block, there was also this 4-hour order block over here, and this was another reason to sell because of the fact that at this level there was a 4-hour fair value gap over here. Okay, so if we just zoom out one space, so we got a 4-hour order block, daily order block, 4-hour fair value gap, 3 confirmations. Okay, so you can see that price had closed that fair value gap, and if I pull my fibs from these 4 hours to these 4 hours lows, you will see that is a perfect sweet spot, all aligning up with each other. 50% of the daily order block, just tapping our 4-hour order block, closing our 4-hour fair value gap. So just by that, we also have a institutional level of 200 over here. So that was also a similar setup with a similar result. We're doing the same thing every day, looking for these setups and taking the trades. And sure, maybe you'll take a few trades based on this, but the idea is to make pips, positive pips. So if you're taking less trades, but you're having a higher accuracy, well, then you are doing good. There's no reason to take 20 trades a day, 20 trades every 2 days, or 20 trades even a week sometimes. Forex isn't an everyday trading thing. If you can identify one setup a day, well, then that's fine. There's no reason to trade all the time, every time. That's a failure many people make. Any questions?
Hi, Darren.
Yes.
You usually say that when price goes to a level of interest, we should wait and see how it reacts so that we know we're going to enter. What do you mean by this?
So if you are able to sit in front of your PC and trade, then there is no reason to set limits for yourself. Okay. If, however, you are a person who cannot sit in front of your PC or your phone for waiting for price to come into the area you want to buy or sell at, then you have to wait for price action. However, it is up to you or what type of lifestyle or job you have to be able to make use of, setting limits or buy limits. It's up to you. So if you can sit and wait, well, then you don't have to have those limits and you wait for these reactions to occur. If you cannot, then you have to set your sell or your buy limits, or you won't, or you'll forget to make these trades.
So the trade you just showed us right now on USD CAD, is it possible to go to lower time frames and reduce the risk?
Yeah, of course. So here we have a daily order block, this blue box, this 4 hour order block, this red box, this purple box over here is our fair value gap on the 4 hour time frame. Now, if we go down to a 1 hour time frame, uh, you can essentially wait for price to get into the zone that you want to sell at. And there we have our 200 IPL. We also have our round number IPL over here, okay, which is a much lower. So it's 20 pips lower than our 200 IPL. So inside this entire IPL range over here, you are essentially looking to sell because you have multiple confirmations for the reason wanting to sell. So you have daily confluence, you have 4 hour confluence, now you have a fib sitting over there, and also uh, you can essentially go down to the lower time frame even of 15 minutes and see the exact same thing where price goes up into the zone you want to sell, and instead of now going and breaking price higher above our 200 IPL over here, you can see that price is starting to reject. So even if you don't get a wick entry, it doesn't matter. It really doesn't. The matters that you are getting into where price is going. And even if you entered on any of these candles to the downside, because you are using a 4 hour, a daily, and you had a fair value gap, you know that there's orders sitting there that will take price lower. I have the confidence to say that I will trade even on these candles over here because I can place my stop just above. So I'll wait for price to get here, close this fair value gap, respect my order block, and when price I see start to drop, well, then I can enter on any of those 3 or 4 15-minute candles. Now, sure, it's not a great entry, but you can still essentially put your stop just above. And that stop just above on a 15-minute time frame is only, say, 20 pips, 25 pips, which will still give you a good risk reward ratio than if you're using, say, 40, 50, 60 pips, whatever you use. But essentially, the lower the time frame you go, the better entry you can get and the tighter the stop loss you can use. Yes.
Thank you, Dar.
Benson, did you have a question? Okay,
I think that's all.
you
No,
do. You
no,
don't have a question.
no, not really.
Okay, no problem. Um,
So yeah, I remember right now. Someone said, I mean, could you show us how you inserted the Q zone option? I mean, was it only peculiar to your MetaTrader?
well,
Can you find it?
essentially, you just have the kill
Okay.
zones placed. This is just time over here. There's nothing essentially about it. This represents 10 a.m., this orange line over here. So you could go and put a vertical line at any time you want over here. So this is 10 a.m. Kill zone because that is the time for my time kill zone. Your time zone will be different for wherever you live. But these two, red and blue, are the London and the New York kill zones. And this little box sitting over here is our Asian range of where price trades through during the Asian hours, where most of the world
Oh,
is sleeping. So,
thank you.
um, okay, so Hesbin, you asked when the market is ranging, consolidating, accumulating, compressing, as all of the terms essentially are called. If we look at something like this, you can say that when a market accumulates, so we will use an accumulation on a 4 hour time frame to assist your question. So you asked when the market is ranging or consolidating, it seems like that what follows is a sharp movement